Seventh floor.
We'll see you around the timeline. Feels good to be back.
I think that Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm with Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Is headed to the top. If we're not already at the top, we're going to the top.
We're going.
Rollup is my favorite.
People from all walks of life, all over the world, all over this industry, come together for the Rollup.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go. Welcome to the nest.
See you on the show. It's Friday. Let's go. It is time to revive the bull market, guys. I appreciate you rocking with us. We have a great show for you guys here today, July 17th, Friday, headed into the weekend. Trump basically said that China's meddling in American elections last night at 9 p.m. He also mentioned that we were coming off a super friendly inflation number in the CPI that was much lower than expected. Inflation's coming down. So what does that mean? It means that we can go after another country and heat geopolitical tensions up because prices are coming down. And so this has been the back and forth that we've been doing in the macro markets. Guys, incredible show for you guys here today. Only a couple of guests. We got a dog barking in the background. We've got Holly from 1inch going to join us first. And then we've got Cronje, the DeFi mastermind behind so many projects, most notably and most recently Flying Tulip. He left Sonic and now he is part of Flying Tulip. As always, shout out to our friends over at Plume. These guys are doing incredible work. They are recently partnering with the likes of TradFi all across the docket. Clarity Act and Salman from Plume is doing incredible work in DC. I am not in the tokenization tower. I am here in sunny South Florida, getting some sun, staying warm. But as always, shout out to our friends over at Plume. We've got another great show for you guys here today. Like I said, Holly of 1inch, Andre from Flying Tulip. Guys, hit us up in the chat. New Type, as always, has been rocking with us. He's still bearish ETH. That Lorenzo tweet. Lorenzo's a friend of the show. He hasn't been on in a while, but Lorenzo's a good friend. Lorenzo tweeted about how ETH is only made $1,500 from fees while Robinhood Equity is making $100,000 from Robinhood Chain. ETH is so fundamentally screwed. New Type, man, you got some good analysis out there in the chat, buddy. New Type, man, we're going to get you, one of these days, we're going to get you on the show. But for now, we're going to be rocking with you in the chat. 100% agree. Look, I do think there is a path for ETH, the asset, to do quite well. I actually think the disintegration of ETH Foundation is a bullish development, but still remains to be seen. Are they going to be a revenue producing chain? Are they a software company, or are they fundamentally different? This remains to be seen, but I agree. And the other part to take away from Lorenzo's tweet was, look, Robinhood Chain they probably wouldn't have gone anywhere else. Robinhood, even if ETH was charging an order of magnitude higher, say $150,000, not just $1,500, right, or $15,000, could be 2 orders of magnitude higher. Robinhood still probably would have launched on Ethereum. At a certain point, I agree, the pricing mechanics don't make sense. They would leave, they would go elsewhere or build their own thing. But ETH has a lot of room to increase prices and still retain their customers. So the ETH pricing model will get fixed. I have faith. I do think, look, I think ETH is bullish in the long run. We'll see. Yeah, that would be legendary to meet you guys in person someday, maybe at a conference for sure. New Type, I would love to. We're going to make it happen one of these days, buddy. Like I said, Holly from 1inch, Anton from 1inch just recently left 1inch. We're going to hear about that. Also, Holly and 1inch team put together a nice research piece from Dune, talking around the total addressable market of idle capital in DeFi. So we're going to be talking about that. And of course, Andre Cronje, guy's a character. We're going to be there's plenty to talk about there. Our topics today are sponsored by Trezor. We're going to get into it. We've got plenty to cover before we hit up our guests. So let's get into it. First, we're going to give a quick shout out to our friends at Relay, at Frax. Frax is our stablecoin, future of digital money. This is open, stable, borderless money. Frax is leading the stablecoin race, and we've got our stabled up episode powered by Frax today with Andre Cronje. You guys are going to want to tune in for that. It is sunny. It is sunny in South Florida, and that is what we are facing here. This is powered by Relay, and Relay will take you everywhere you guys need to go. Relay is doing incredibly well. I mean, I was just looking at some of the cross-chain interop stats the other day, just thinking through like, okay, where are we at when it comes to bridges? What does the cross-chain landscape look like today? We were thinking about the agentic economy. We were thinking about how these things are moving, and Relay is just crushing it on all angles. I mean, daily active users, daily transactions, monthly volume. I think they're doing something somewhere in the billions of dollars in monthly volume. And then you look at like how many users, like they have got a large swath of activity that's going through their platform, which is very, very cool to see. So shout out to Relay. Appreciate them sponsoring our weather segment for today. Not much to talk about. Guys, what do you guys think? This piece is called The Collector. Our collector friend here, he's looking at a coin right here, right? He's analyzing. Tell me what you guys think. We're gonna get some art pieces in here. We're gonna spruce the studio up even more, and we're gonna keep on keeping on here at the Rollup. Guys, let's keep things rolling. We're gonna get into our markets segment for today. And of course, before we do, we're going to tell you about Denari. Denari is our tokenized equities partner at the Rollup. Tokenized equities are recently taking the world by storm. The consensus view now is that there is a larger addressable market for tokenized equities than there are for stable coins. I don't know exactly how people are making this comparison. The point is that both of these are tremendous markets. The equities market is on the scale, I think, of $29 trillion. That is, of course, a massive market. And then obviously tokenized cash in the form of stable coins. There's a lot of cash and cash-like instruments out there as well. Stablecoins also a massive opportunity. Denari is sponsoring our daily equity segment, which we are going to get into in a little bit. Our markets for today are a little bit down. Yeah, NEAR is down under that $2 mark. We wanted to see that hang on. Chainlink under that, they were hovering around 850, but they're hanging on to that $8 mark. Solana right around 75. Saw a post yesterday that was getting circulated that said Solana was never going to hit another all-time high. Painted a similar fractal around Ethereum and what they were doing. Ethereum, of course, kind of double topped around that 4K mark. People were expecting the world, calling for 12K. Tom Lee is still calling for 12K. We will see if we get there. But I think Solana is in a very precarious position. The markets in general are looking a little bit rough today after that macro speech from President Trump last night, calling out China. I was explaining the geopolitical dynamics that are present in the world today to a very good friend of mine, and explaining how right now you've obviously got the capitalistic Western powers. These are at odds with the Eastern powers. You've got this cohort of China, Iran, Venezuela, and then you've got, America, which has essentially abandoned all of, our partners. Europe is kind of going in its own way, and we're kind of going in this multipolar world with not just US and not just China, but, the US, China, Europe, Southeast Asia, Taiwan. These guys are all sort of moving in very disparate directions. So we're going to see what happens. But it feels as if Trump is approaching the world as if it's a video game. And he said, level 1 is Venezuela. We're going to go in. We're going to snatch Maduro. He's going to walk out in a tracksuit. And what do you get for beating level 1? You get a little bit of gold. You get a little bit of oil, right? So you get a little reward. Then you play level 2. Level 2 is Iran. We're having a little bit more trouble with level 2, right? But then eventually you get to the boss level. And it seems as if Trump is ready to take focus away from Iran and put it onto China, maybe for the election season in November, or maybe for some other reason we don't know. But this was the topic of Trump's big press conference last night. And this is sort of why markets are down, despite having the impressive inflation numbers come in and, the market bounce up over the last couple of days. So let's keep moving. Of course, markets today are sponsored by Zama. Zama is leading on the privacy front. We're going to do another privacy day in a couple of weeks. We're also going to get the Zama team up here with a couple of their partners. I think we're going to get Pantera in a couple of weeks as well. And we're going to talk to all of these guys who are doing incredible work. So Zama and Zcash, I got to say, just while we're on the markets conversation, Chamath, and I think we're going to cover this tweet in a little bit. Chamath Palihapitiya, the venture capitalist, he's extremely disliked out there, but these guys, they make a lot of money. They tend to have some pull, and whether you like them or not, people take what they say seriously. Chamath put out an article describing how the large swath of the crypto asset class is down, and he gave this breakdown of how much each category was down. Unfortunately, all the way on the left for our Celestia modular friends, data availability was down like 77% overall as a category. And then you saw smart contracts, DeFi, DePIN, everything down, typically like 50% plus. Bitcoin was down 41% according to this chart. ETH down something like 40%. The one category that was up was privacy coins. This was obviously led by Zcash. Zcash is holding up quite well. I mean, I see here it's up around 550. Last time Zcash was at 550, it was pre-Orchid exploit. Near was at like 250. The three-headed dragon VVV was upwards of $20. Ethereum, or excuse me, not Ethereum, but Hyperliquid was in the $70 range. So Zcash has tremendous relative strength, and that is what Chamath was depicting in his article. And all that to say that Zama also falls into this category of privacy coins as well. If we're checking in on Zama today, it's holding its own. It's flat. It's pretty much hovering around that 3.5 cent mark, which is where it sort of, essentially where it launched. Frankly, it's after it found a low at around 1.8 cents, it's been up only. So take that what you will, but it looks pretty good. It looks pretty good. Let's keep moving, guys. We're going to get into some of our tweets that we have for today. Shout out to Bit5050 in the chat. Hey, yo, Optimism. Appreciate the 2 silver stars. Not sure exactly what we get for that, but we appreciate you guys rocking with us here in the chat. Before we get into our tweets, who do we have for you guys here? Near is our exclusive AI partner. Our exclusive AI partner, One Account, No Borders. You guys heard about the virtual Near Day yesterday. Tremendous success. Had a bunch of panelists. Very, very good show, and appreciate all of them joining. It was a really great show, and encourage everyone to check it out from yesterday. Guys, we're going to get into this with our first guest, Holly from 1inch. But this is what we're going to be talking about. So if you're interested in the amount of idle liquidity that we have on chain today, then you want to stay tuned for our first guest. Dune Research finds 85% of concentrated DeFi liquidity is underutilized. Remember, Uniswap, AMMs, all of the entire AMM landscape transitioned from this V2 model where you just put your money in this pool and it was going to use this XY equals K formula to rebalance when swaps were made. This led to impermanent loss. This led to a lot of things, but this was the necessity that was required in order to facilitate automatic exchanges and decentralized exchanges in a low liquidity environment, which was the case when DeFi first started. But now we've got more liquidity. We moved to this concentrated liquidity model with Uniswap v3, more recently Uniswap v4 with hooks. And so now 85% of concentrated liquidity across decentralized exchanges is not doing the work it was deposited to do. The thing about concentrated liquidity is that it needs to be actively managed. According to research by Dune, commissioned by 1inch, this study rebuilds every liquidity position in roughly the top 200 pools by activity on Uniswap v3, v4, PancakeSwap, and Aerodrome Slipstream, taking 26 weekly snapshots across 7 chains between Jan 6th and June 30th. All right, that data set feels pretty expansive. Covered 1.84 billion in liquidity on average per week, approximately 1.6 billion of which was underutilized at any given time. Yeah, that sounds like about 85%. Pretty insane. Let's see what we've got. 1.6 billion, 85% of the liquidity there, I think is just saying that it can be, because the concentrated liquidity model needs to be actively pushed into the direction of where the price is, it seems like that could just be a more optimized process. Let's keep reading. Concentrated liquidity introduced with Uniswap v3 lets a liquidity provider set the price band their capital covers rather than spreading it across every possible price. Remember, that was the Uniswap v2 model. It was designed to offer an improvement on the constant product venues it replaced. Constant product was Uniswap v2, concentrated liquidity is Uniswap v3 and beyond. But again, you need to move the liquidity so that it is encompassing where the current price is. If the price moves, you need to move your liquidity. As a comparison, Dune found roughly 98.7% of liquidity on constant product AMM sits outside the day's traded band. Yeah, which means like if you spread across the entire price spectrum, most of that liquidity is never getting utilized. Out of range is only the floor. The strictest measure is out of the range since the market price sits outside a position's band, so the capital earns no fees and adds no depth. Averaged over the 26 weeks, which is, half of the year, 29.5% of track capital was in that state, or roughly $500 million in an average week. According to Dune, the figure barely moved, apart from an early February spike that touched 41%. The out-of-range share held inside a 25 to 35% band for the entire period. I mean, these are pretty consistent results. This is like a large data set. This is a large sample size. And so it does signal to me that these are pretty reliable results. Being in range is not the same as efficiently working. So even just being in the range of the price that, is taking place that day doesn't necessarily mean that liquidity is working as efficiently as it could be. A position counts as in range the moment the price falls anywhere inside its band, however wide that band is drawn. All right, so just because you're inside the band doesn't mean that your liquidity is being used and put to work. Let's keep scrolling. So why did 1inch commission this piece? This is what I'm curious to know. And so being in that range, we want to scroll down a little bit more. Rebuilding the broader calculation from 1inch's Aqua white paper. Dune found V3 family capital splits into 13.7 actively used. All right, here's the quote. Due to structural inefficiencies in DeFi, liquidity providers are leaving billions of dollars in underutilized capital and millions of dollars in fees on the table. That was by Cronje, the 1inch co-founder. Coons added that 1inch is preparing to launch Aqua, a shared liquidity product aimed at the same problem. All right, so we are going to get Holly up in a little bit to talk about exactly this. But let's keep moving. A third of the idle money has not moved in 90 days. Out of range capital is not automatically abandoned. Okay. This is incredible. I think these are good research studies. Ultimately, we've seen a lot of these studies across the board, but what the conclusion to draw here is that we need to do something about this to make sure that we are more properly utilizing all of this capital, and therefore we're making the on-chain economy more efficient. So we're going to bring Holly up in a few minutes. Let's move into some more tweets, and we're going to get back to talking about this with Holly, getting an update on the 1inch side of things. Let's kick it over. Killa XBT. I mentioned this in the beginning, but guys, unfortunately, I share this opinion until I'm proven wrong. Killa XBT says on Solana, they refuse to accept that their favorite altcoin will never hit all-time highs again. I think people are probably initially triggered by calling Solana an altcoin. That is the case. This was the perfect exit pump FTX needed to offload. Don't really know where he's getting that information. Do the homework on token inflation. Imagine buying an asset when the Solana Foundation can print new tokens out of thin air. It's a classic VC-driven coin with massive supply concentration in the hands of a few insiders and funds. You think Sol organically went from $7 to $300 because of demand? Demand? No, did not go. And let's show the chart. It's pretty rough to see this, but yeah, that is the suspected path here. So pretty rough. I mean, I've gone on the record and said that, right now the Solana meme coin trenchers, just sort of left a stain on the Solana ecosystem. Unfortunately, I think Solana is going to need to overcome this. It's pretty incredible because, Pump Fund is still doing quite well, making a ton of revenue, but their token is just not doing well. So, Pump Fund needs to figure it out. Solana needs to figure it out. Cash Cat is down today. Robinhood is transitioning from meme coins to, RWAs. I don't know what is the thesis here for Solana. They're really going gung ho on tokenized equities. I think they need that to work in order to figure out it is a massive opportunity. And so I do think you could see this sort of bounce. Tokenized equities could get quite big. I think this is a one-way train. I think we're only going to see equities move in the on-chain direction until they reach some sort of significant market share. And there's a lot of room to grow in that regard. Whether Solana reaches another all-time high or not remains to be seen, but I do think there are companies and coins out there that have supply models that are much more beneficial and healthy and sustainable than something like Solana. You heard Killa XBT say Solana's supply model is unconstrained. People can basically print the tokens via inflation. You also have VCs that are just waiting and continuing to wait on unlocks, in theory, going to dump those on the market. There are coins out there, and I would point to Hyperliquid, I would point to Near especially, where these are essentially fully diluted. Maybe there is some small amount of inflation. For instance, on Near, we heard yesterday there's about 2.5% of inflation. They are working on taking that out. As there's more revenue, they don't need to inflate their token. They can actually just use the revenue to pay for economic security or security in general, to pay those validators in cash, so they don't need that sell pressure on the token. They can do that. And there are more examples of revenue producing supply limited companies out there that don't have VCs or have already washed out all of their VCs. Hyperliquid, Near fall into this camp. I just, this, even if Solana gets the tokenized equity thesis right, I just don't want to be in something that has the supply overhang at risk. It is a systemic risk from a financial point of view. Solana can still do great. They can have great technology. Maybe 15 years from now, the unlocks are going to take place. The paper hand VCs are going to get washed out, and the people that are still in are in, and the token's going to be fully diluted. And then you could really see some movement. Things are still extremely early. I'm not going to say they're never going to hit another all-time high, but in the near term, I think there are alternatives out there with better supply mechanics. That is where I would be focusing my attention. Guys, we're going to get Holly up in just a moment, and then we're going to have some more time before our stabled up guest at 2 p.m. in an hour. So let's go ahead and bring in our first guest, Holly. Holly is in 1inch. 1inch is obviously, been around a long, long time. These guys are doing incredible work on the DeFi aggregation side. Holly is a general tinker. She is hands-on engineering, product leadership, regularly sharing technical deep dives on EVM mechanics, RISC-V and Web3, smart contract upgrades. So I'd be happy to get into a little bit more of a technical conversation here as we think through what the cross-chain landscape looks like and what the liquidity landscape looks like in a paradigm where we've essentially moved entirely off of the typical AMM world, and we're in this concentrated liquidity world, which requires just different sorts of liquidity management on chain. So it's an exciting paradigm. Let's go ahead. I see Holly's ready in the back. Let's go ahead and bring her up on stage and kick off our first segment for today. Holly, welcome to the show. It's a pleasure to have you.
Hi, thanks for having me.
Absolutely. I was just talking up 1inch a little bit. You guys have been in the game for a long, long time as one of the main DeFi aggregators. DeFi has evolved quite a bit. Before we get into all the technical innovations that you guys have in this research piece commissioned with Dune, it is your first time on the show. I'd just love to hear a little bit about yourself, your background, and how you ended up finding 1inch.
Yeah, very happy to be here. Thank you. So I've joined 1inch as Chief Product and Technology Officer. Obviously, that means I'll be bridging product with technology. This is coming from a kind of mixed background, spanning commercial roles on the one hand, and then tech on the other with a career in blockchain-based roles.
Very cool. Very cool. And before 1inch, what were you doing?
So earlier on in my career, I was in commercial roles in project finance, renewable energy. After pivoting to tech in 2018, I've been in blockchain-based roles as a developer, full stack developer, blockchain developer, and lastly, blockchain architect. I've also been head of metaverse technology at Poison Protocol.
Very cool. Awesome. And so let's get into what this piece around, DeFi liquidity says with Dune. You guys commissioned this piece. It essentially says 85% of the amount of liquidity that is currently out there in the AMM landscape is not being utilized to the fullest extent. Earlier in the show, we walked through what the liquidity landscape looks like today because we moved off of the XY equals K model where liquidity was spread across the entire, price spectrum. Now we're in this concentrated liquidity model. We define these bands of prices. That is where we're concentrating our liquidity, but it requires more active management. At least that is my understanding. We need to move our liquidity and manage it so that it is constantly encompassing where the current price is at any given time. And it seems like liquidity providers are just not managing their liquidity positions as effectively as possible. I'd love to hear from you. What did you learn as a result of this research piece from Dune? And then we'll get into all the exciting things that you guys are doing to help correct this massive problem.
So yeah, the headline is what we've learned is that liquidity providers are leaving money on the table, right? So to the extent that they're not automating their management, there is around 85% of DeFi liquidity sitting underutilized, meaning the liquidity providers are not earning as much as possible, not earning to the full potential of what they're providing to protocols. And from my perspective, there is a gap here, right? So capital efficiency is the next frontier for DeFi. If the industry wants to
Cool. And so this, we walked through some of the statistics here, but this was a pretty comprehensive report. I think it was almost $2 billion, $1.8 billion over 26 weeks, 7 different chains. You looked at Uniswap v3, you looked at Aerodrome, you looked at Uniswap v4, PancakeSwap, very, very expansive in this research. And it found that, these positions weren't being managed as effectively as possible. When it comes to, what we can do, and I think maybe there is still more to say around like the scale of this problem. This is 85%. It's on the scale of billions of dollars, but I think really what catches people's attention is, these are liquidity providers that are leaving fees on the table. And I think something, it was mentioned in the report, hundreds of millions of dollars that were being left on the table by these liquidity providers. So when it comes to doing something about this, what are liquidity providers currently doing now that is obviously falling short of expectations? And what can we do as liquidity providers to correct this course?
You're right. So out of range positions are missing out on roughly 100 million in fees every year based on this study. What is typically happening is that liquidity providers, a typical AMM approach is using pools, right? So the liquidity providers are sending their tokens to pools and losing control over what they can then do with those tokens. And what 1inch is doing is now bringing a new approach to with 1inch up.
Very cool. Give us a quick chronology about, where 1inch has found itself in the DeFi landscape up until now, and then obviously going forward, there's this new shared liquidity protocol that was announced Aqua, our community wants to hear a little bit more about that. And so before we get into Aqua, maybe you could just give us a little bit of a pre-context about where 1inch has been and the previous role that it's found itself in the DeFi landscape.
Absolutely. So 1inch began its life as an aggregator protocol, finding the best route for people who want to carry out swaps. Now, 1inch has evolved itself into an aggregator ecosystem. We are focused on building a complete ecosystem around that. We are providing the infrastructure rails for routing across chains, across the whole system.
Great. Okay. And so, I think the thing that people are curious about is obviously Aqua. This is something that was mentioned in this Dune research report, and I have a feeling this is sort of, you do some research, you find a problem. Obviously, you do some thinking around what the solution is. And so I take it Aqua is most likely the solution to this idle capital problem, helping people retrieve the hundreds of $1 millions of fees that they're leaving on the table. Just generally, what is Aqua? What can we expect? As much as you can share, we'd love to hear about.
Very happy to talk about Aqua. So Aqua is a shared liquidity layer. So what does that mean? It means that it works somewhat like a registry. So users connect a wallet and then approve a token balance to back as many liquidity positions as they like without actually depositing their tokens anywhere. So the user's tokens stay in their wallet. Obviously, 1inch is all about self-custody, and we always have been. Aqua then manages order flow and calls on the user's wallet to fill orders as per the instructions that have been positioned for anyone.
Allows them to calls for it, but is it the fact that in the current regard, it seems like these tokens are maybe way out of the price band in the concentrated liquidity position? Is 1inch managing this liquidity on our behalf? It's pulling the liquidity in when it needs it. And is it doing that? And it's just able to, algorithmically optimize where the liquidity is concentrated at any given time? If so, just how does this work? Maybe you could just unpack a little bit more around the mechanism here.
So the Aqua system provides a virtual balances approach, if you like. So the liquidity provider can allocate their funds to as many positions as they like, tracked by the virtual balances system. And as you say, those funds are then pulled when required. The user has full control over their funds, and it's made super clear in the system how the allocations are laid out, and the user can see that in the UI and can track accordingly. So there is some management there on the user side.
Got it. And is this primarily geared for crypto native assets? There's such a big push into tokenized equities, tokenized RWAs, right? This is making kind of the headwinds, the headlines. There's calls right now around tokenized equities being a bigger potential market than stable coins, right? So everyone is very, very excited about these stock tokens. I think Robinhood, which 1inch is helping people connect to Robinhood and help them go cross chain. Robinhood is helping expand this narrative, but this stock token idea is catching a lot of wind. Is the liquidity management system around Aqua, is that geared for a particular asset class, or because these are tokens, everyone is on chain, this is effectively applicable to all asset classes, or is it primarily crypto native or RWAs? Where does the liquidity management system fit in?
Well, the beauty of Aqua is any number of strategies can be deployed, right? So if you're asking, will Aqua go live on Robinhood chain, for example, the answer is yes. We we cater for all tokens, ERC20, we cater for RWAs, tokenized stocks.
Very cool. And what have you, given that, I always find this fascinating when
In Hood Chain, we've seen rapid expansion in the RWA category, huge volumes taking place there, which is great, right? It's a major step towards tokenized real world assets and bringing that on chain. So I'm proud to say 1inch has been a partner there since day one. Our focus really is to provide the best routing and intent-based swaps for everybody to be able to connect in their assets. So for us, we are very aware of the trends, obviously. Of course, it's important, but really our view is about what needs to happen in the future to connect DeFi with TradFi. So from my perspective, from 1inch's perspective, DeFi is for everybody.
Very cool. Given that you've got some history in the DeFi space, and so does 1inch, as you look forward, DeFi as a whole, there's been calls around RWAs. There's, these principles of, we're going to let our agent kind of interact with everything on chain. People have some varying ideas about, where they expect DeFi to expand and evolve. I'm just curious, do you have any hot takes as far as what you expect on the DeFi landscape? Anything that you're continuously focusing that gets you excited, that says, I think this part of DeFi is going to grow? Just curious if you have any bold takes here.
Well, I think to pick up on what I've just mentioned, DeFi is at a pivotal moment. So it's really evolving from a niche industry, if you like, into a key part of the global financial system. So the next 12 months there will be transformational, particularly as tokenized assets, institutional adoption, and AI also accelerate. DeFi will become more efficient and accessible than ever. So 1inch is there for that. For us, it's about building the infrastructure for that future. So not following any particular trend right now, but building for that future.
Yeah. And Holly, you're hitting on a tremendous point, and this is something that we've talked about a lot on this show, is that we're building for the future where, the asset classes at the scale of trillions ultimately are being tokenized now. And so previously thought, there was billions of dollars of assets, maybe in stable coins or DeFi, crypto native assets, and that was the scale at which DeFi was operating. Now I think as an industry, we have our eyes set on, the tokenized equities asset class. For instance, $29 trillion. Stable coins, for instance, has its eyes set on, 400, 500, if not, $3 billion of stable coins. And this is all the way upwards of, at least in the US, the Secretary of the Treasury that is called for $3 trillion of stable coins. And I think what we're seeing play out now with this tokenization super cycle is, first we tokenize these assets, they end up on chain. Once they end up on chain, people are going to want to do things with these assets. There is this sort of mass awakening around the programmability and the productiveness that these assets can provide. And so once these things are tokenized, the next step is that they end up landing into DeFi protocols. And I think 1inch sits at a very unique position in which it can facilitate the movement of a lot of these protocols and these assets around these protocols. And all of this is just to say that, we suddenly have moved from this collective industry, total addressable market in, maybe billions, to that of 29, if not more, trillions of dollars. And so suddenly I think we're seeing these DeFi protocols get re-rated with the new potential market size and the size of the opportunity here. And so I can understand how, you guys are taking an RWA, oriented approach, also a shared liquidity approach to prepare the infrastructure for the onslaught of new tokenized assets.
That's exactly right. So from Aqua to cross-chain innovation and best-in-class aggregation, we're focused on making on-chain finance seamless for everybody.
Yeah, yeah, absolutely. And so, given that this is the case, and this industry is getting re-rated higher in terms of the amount of assets that are taking place here, what kind of advice would you give to? I'm going to make it a two-part question. What kind of advice would you give to liquidity providers, right? Because they're sort of a fundamentally different audience. And obviously I think in maybe a few weeks or months, right, the answer is just going to be use Aqua, right? But that's not available right now. What can users and liquidity providers do right now to improve their liquidity provisioning, ultimately take back some of the fees that they're leaving on the table? Let's start with liquidity providers, then maybe we'll get into users and maybe institutions as well.
So I think until Aqua is officially launched, which by the way is a matter of weeks, not months, um, liquidity providers need to have awareness of what their capital is doing, right? I think this is not necessarily the case as we've seen from the data.
Yeah. Yeah, they need to stay aware, absolutely. And I think, this was previously something that the industry itself was unaware of until this research piece came out. And so kudos to you guys to partnering with Dune and providing some of the impetus to do this research. And so that's on the liquidity provider side. Now let's flip our, over to the let's say the institutional side. Obviously you guys have interfaced with institutions, and we're seeing the tokenization super cycle play out at the scale of BlackRock, Robinhood. All of these guys are just, the kingmakers of financial institutions these days. The incumbents are coming on chain. What advice do you have for institutions that are maybe even more so unaware, right? They're less educated, they're less crypto native, they're now doing the due diligence and kind of, sticking their toes in and testing the waters. What advice do you have to institutions that are now taking their foray into the on-chain landscape?
Well, obviously we've seen the on-chain landscape explode over the past few years. Obviously our focus, and I don't wish to give advice to institutions. From my perspective, this is what 1inch is focused on. It's about building the infrastructure for the future to provide the best in-class process for all parties, no matter what chain they're using, no matter what kind of tokens they are interested in.
Great, fantastic, and it's a tough market out there, but I take it this is not your first bear market. This is not 1inch's first bear market. You continue. Thank you so much for joining. Really, really appreciate it. I think it's time to party with all the people that are in there, and they're excited about Aqua. They're excited about 1inch. So thank you so much for joining, sharing some insights from this research piece with Dune, and we're looking forward to Aqua launch and joining you again.
Thank you so much, Robbie.
We'll see you next time. Thanks. All right. All right, guys. That was Holly from 1inch. Pretty exciting about Aqua. Man, leaving a ton of fees on the table. And so, yeah, I mean, obviously you guys heard from Holly. She's doing all the product work over there at 1inch. And so, we are seeing developments. I mean, that was a pretty comprehensive study. I think the research piece in and of itself is going to benefit a lot of people. A lot of protocols can learn from this research. Obviously, 1inch and Dune sort of had this first, and so now they can do something about it. And then we're going to, I think, see a lot more of these infrastructure providers do a lot more of it. Guys, we're gonna get into more news. We got plenty more tweets to cover. We're going to do some more tweets. We're going to bring you guys our daily equity segment. Let's see. Hope you guys enjoyed that segment with 1inch. They're a new friend of the show. And so I think we're going to bring them on again soon. Continue to hear on the DeFi aggregation side, everything that is happening. New type in the chat. Fading Killer XBT tweet. How can he say there was no demand for Solana? We literally had the president of the United States launch a meme coin on Solana with no hiccups. Yeah, all right. I mean, that did mark the top. That was the literal top. New type. I love you, man. I don't want to see you get left behind. I remember there was a tweet that ETH was the new Bitcoin, Solana was the new ETH. I think there is a lot of good building, good infrastructure happening on Solana. I think in order for it to really like legitimize itself and get some real revenue and see some real demand for the token, it needs to have an institutional strategy. And the number one application there is still Pump Fun. You know, we're still talking about the president launching the meme coin on there. Maybe I'm wrong. Maybe, you know, and I do think Solana is generating like more like chain revenue, REV, real economic value, than most other chains. And so it is generating revenue. I think a lot of that is from like actual apps. Backpack is doing great. There are real like sources of activity on Solana. I just don't know if what we see there, unless it really capitalizes on the tokenized equities market. But even that, even if that's the case, and I don't know if it will be the case because you have Robinhood and you have stock tokens on Robinhood. I mean, they're just in an incredible position with, you know, Gen Z and like new era financial people coming into newfound wealth. Robinhood is an incredible position to benefit from stock tokens and tokenized equities. I think more so than Solana. So I think Solana's got to like catch up, then overtake in order for it to capitalize on tokenized equities. And even if it does that, and I think it's unlikely, but even if it does that, I think the asset itself, you know, has this supply overhang that it needs to overcome. So that is where I think a lot of this comes from. I definitely understand the take that Solana will not make a new high. A lot needs to change. Sol needs to change inflation rate. Solana needs more private layers for enterprises. Yeah, man, I think you got it. And I think, you know, the most important thing that you just said there is that it needs to change its inflation rate. I mean, look, if this thing has real revenue, why does it need to inflate its token? Like, it can just pay, if it needs to like pay validators, and that's why you have inflation on these things, just pay the validators in cash. Just use the revenue from the chain to pay the expenses for the chain in cash, so you don't have the sell pressure on the token. There's already going to be enough sell pressure from the VCs. That is where I think you need to like control the supply, control the selling pressure, so that you can actually overcome that with the amount of demand that you do have. And obviously you need to increase the demand so that you can more easily overcome that. FOMO app is killing it, but I want to find out what chain is attributing to most of the FOMO growth. Is it mainly Hyperperps or the Solana memes? Yeah, I saw a lot. I saw FOMO was crushing it. I don't know what that was for. So yeah, I would check out FOMO. I think I've seen that they're crushing it as well. New Type, as always, man, appreciate you rocking with us. We appreciate your perspectives here, because I'm not going to say that we get everything right, but you know, we want to have all the smartest people on the show, and your questions, your perspectives help us frame what we ask these guests. So keep them coming. We've got another fun one that we're gonna check out now. We're gonna cover some more tweets, and we've got Stabled Up with Andre Cronje in a few minutes. So let's bring it up. We're gonna bring up. We just had 1inch on the show, so we're gonna bring up our first humanoid robot kickboxing match. We don't want any more commercials, guys. We want to get right into it. First humanoid robot kickboxing match officially happened today. I saw this. I was like, I need to show this on the stream tomorrow, because I mean, I saw people commenting and just saying that this was like the next biggest sport. I agree. I think this is going to be huge. Just watching this for a little while, this is in the most crude state that it will ever be in. It's only going to get more entertaining from here. Let's go ahead and play the clip.
斗牛士不会又晕了吧？哇！正面的倒地 ！Oh my god！ 哦，但斗牛士很快进行了还击。 梅开3度的这双方势均力敌。哎，这个飞踢要中了！哎，我感觉斗牛士的头，他晕了，他晕了，他晕了！斗牛士受到重创，哦，
摇头晃脑中啊！
不会打，不会爆穿的，真的要
neck is wobbling. I think he lost his head.
斗牛士还 还能坚持吗？斗牛士他还在，
真的是太顽强了，
他还在努力。
Oh my god, how do they keep
斗
score?
牛士他还在坚持。但我觉得这个需要裁判的一下判定了啊。
我觉得这个体育精神是可歌可泣的。
体育精神这一块
Oh my god, the white robot's dancing
还
in the
真是
ring.
是的，厉害啊！
我们看得出来，这个斗牛士的主创团队真的很用心了
Do。you guys like this? I
现
find this
在有怎样的一个
hilarious.
优势呢？我同调了，你就踢不到了。
少了一个得分部位。
我同调了。
They said once the head comes off, the head kick no longer counts. Oh my god.
又是正面的击倒
Roundhouse to the
白
face.
色雄鹰再击3分，哇！斗牛士依然在下手，名字真没去过啊。斗牛士头还是很跳的。哎，我这就想说一句，兄弟，头晕是正常的。哎，真掉了。
But you already know they're going to be doing these underground robot fights in the basement somewhere, just good old fashioned fight club. And I've been saying it. I think you guys saw. I had a 20-minute. So you guys asked me what my thesis is on a 20-year time horizon. The only thing when I look at like the industries that are so extremely early, I think robotics. I look at this and I think there is so much potential here because not only we're going to use these things for entertainment, they're going to be in factories, they're going to be displacing labor. We already have like the reason that these things are able to do this and actually stand up and throw these kicks. The one is dancing the ring. I don't know if someone's controlling it, but you could just probabilistically put an LLM into the brain of these robots and use that to control all the different facets and components and limbs and hands and arms. All of that can just be delegated to ChatGPT, LLM, specially purpose built for robotics, boxing. And so given that, it almost feels as if you've solved the hard part. Now it's the hardware that is just going to be pumped out and it's just going to the dimensions now, the bottlenecks, and we've heard Elon talk about this with respect to robots. You just got to increase the degrees of freedom. And so like, our hands have like whatever it is, like 29 degrees of freedom or something like that. It's difficult to build that in hardware, but that's the 20-year time horizon, is that we're just going to get really smart designers, engineers, and architects that are going to spend their time working on increasing the number of increasing the degrees of freedom that robots have at their disposal, and frontier models are going to get better. And then you're going to train these models specifically for robots and robotic tasks. And so as these two converge, they accelerate and they compound, robots are going to get exponentially better over the coming years. And I think this is going to be a trend that accelerates and it doesn't slow down. And so again, this is very crude. Like this is basically a joke right now, but I think as these things accelerate and they do get better and improve, this is going to become a serious industry, and you're going to end up with several large companies and markets that are built on the backs of robots. Now it's just about pumping out the amount of robots and improving the degrees of freedom. That's going to make the robot hardware better, and then improving the frontier models is going to make the robotics choices, decisions, mechanics, all of that is going to improve as well. On the show the other day, we did cover like, okay, if you wanted to bet on this asset class growing, how would you go about expressing that view? There's probably prediction markets that would allow you in just betting on, the sheer growth of the robotics industry. You can probably express a pretty clean view in that regard. There was also an index that tracked bearings. Bearings are effectively like this piece of metal that robots need in order for them to function. And so it's, this very important material, this piece that all the robots are going to need implemented in order for them to, work. And so if you wanted to express a bullish view on robotics, you could invest in bearings. And, obviously that would give you exposure to the growth of the robotics asset class. So different ways to express this view. But, and there are other indices, there's companies that are doing investments into the robotics, category as well, like robo-strategy. We saw a lot of, crypto people leave and go into that. So there's different ways to express this, but I would I would take this seriously. I know it looks pretty funny now, but I would take this seriously as this category continues to expand and more investment starts to pour in here. All right, let's keep moving along. Next up, we've got Chamath. Chamath put out this article, and I think it's pretty fascinating. Obviously, there's one outlier in this chart. We talked about this at the beginning of the show, but what we have here is effectively saying all the crypto categories, right? And he walked through data availability on the left is down the most, DPIN down the second most. In here, you got smart contract, oracles, I think bridges, you got NFTs, you got meme coins, Bitcoin, raw, like all of the categories are down, except for privacy coins, he says are up 127%. Obviously, this is led by Zcash. If we take a look at Zcash, my CoinGecko is still on Zama, which is obviously in that privacy coin category as well. If we're looking at Zcash, I mean, it's got incredible strength. It's sitting right around that 550 mark. Over the last year, I mean, it was at 35. Even if you just put easy numbers, you say it was at 55 before it really took off. It did a 10x. And so it did a 10x and the market cap was significant. And so that really dragged up the entire privacy coin category as a whole. Monero also did well during the same time frame. You had other privacy coins. I saw Dash. I saw other things. Near also, you could argue, fits into this category as well as the crypto AI category. And so what Chamath says here is he lays this out. We're just going to quickly go through this article. Is that we have to look at why privacy coins are doing so well. And so the privacy tokens climbed 127% while every other crypto category traded lower. The reason Chamath attributes this growth and this gap in growth to Bitcoin's transparency. So Bitcoin's public ledger makes transactions, wallets, and coin history traceable, which can weaken fungibility. There's another chart in here. Let's scroll down to the next chart because it shows basically, obviously, you know, there's 21 million Bitcoin, but when you really look into it, there's good Bitcoin and bad Bitcoin. And that is what the point that Chamath is getting at here is there's one Bitcoin clean, mined in 2020, you know, fresh off the block reward, came right from the Bitcoin block address in cold storage, sent to exchange, maybe right from a miner into cold storage. That's an example of a clean Bitcoin. But then you have a tainted Bitcoin, mined in 2018. Maybe it went through a mixer. It hit a sanctioned address. It was on the dark market. You know, maybe it got traced into the Silk Road, you know, wallet addresses. So pretty, you know, different life cycle or journey that this clean Bitcoin went on versus this tainted Bitcoin. And so if I'm an investor, you know, and these institutional investors like BlackRock, right? I think last I saw BlackRock had something like $47 billion of Bitcoin in its wallets. And this was because it needs this Bitcoin in order to facilitate redemptions in its ETF. If I'm BlackRock, I don't want to touch the same Bitcoin that was potentially in the Silk Road or hit a mixer or hit any sort of sanctioned address. That creates a very, very murky capital profile for the assets that I have under custody, that I need under custody in order to back these ETFs. And so I think this is a problem that we're going to continue to face. BlackRock is going to face this because they're going to continue to accumulate more accumulate more Bitcoin as their ETF grows. And so you can see where does this chart come from? It comes from Chainalysis, which is the company that's responsible for labeling a lot of these addresses and putting even more visibility into you know, the visibility of Bitcoin and de-anonymizing a lot of this. And so Chamath says at the wallet level, Bitcoin's transparency can expose individuals. A Bitcoin address is more like a pen name than a bank account. It remains pseudonymous only until someone links it to a real identity. And that is Chainalysis' entire business model. If we scroll down, Chamath talks about, what we can do to address this privacy issue. Developers went back to a discovery made decades ago, talks about the zero knowledge proof, and he says, basically gives this analogy to show how zero knowledge proofs work. You guys have been watching this for a long time. You guys already know how zero knowledge proofs work. And so he says the same logic applies to private digital money. In a private transaction, the hidden information is the payment itself, who sent it, who received it, which coins moved, and how much was sent. A zero knowledge proof turns that hidden information into a public receipt the network can check. That is important because the network still needs to verify the legitimacy of this transaction, needs to make sure that there's no double spending. You're not printing new Bitcoin or new Zcash out of thin air, right? It needs to verify these things, but it doesn't want to give this information away. And so he talks about how his research team at Social Capital traced financial privacy from first principles. And he talks about how Bitcoin fails on 4 fundamental properties of money, and explains why gold and cash can pass this fungibility test, but Bitcoin fails. And so if you're looking for real fungible money, private money, and he talks through zero knowledge proofs, obviously this is the cryptographic primitive that Zcash is built on. Zcash is built on zero knowledge proofs. Specifically, it's built on Starks and Snarks. This has been deep research in the cypherpunk community for a long time. We've talked to a lot of researchers that have done significant real work on building out these cryptographic primitives. And he talks about how Zcash, solves a lot of these problems. And so this was like a real piece of research. And he talks a lot about how privacy tokens are going to be viewed in the future. In the chat, we have New Type Trader says, I don't like this path. What happens when North Korea poison transfers like 50 cents of Bitcoin to every wallet? Will every wallet then be blacklisted? It's tough, man. I mean, if they're sending, obviously, right? Like, in the Bitcoin network, you can, the Bitcoin wallets only accept Bitcoin, right? And so there's things that they can do differently on Ethereum or other chains, that they can't do on Bitcoin. But I think what you're saying is, let's say they take Bitcoin and they poison every wallet. I think there's tracking that can be done at the asset level. So we would know that, that 50 cents has, was sent by North Korea if we labeled their wallet, right? And we could point that out and say, hey, this Bitcoin is blacklisted. Don't, touch this 50 cents, but you can still continue to use, right, like the rest of the Bitcoin that you had in that wallet. Yeah, it's a very tricky situation. It depends how regulators are going to look at this. We haven't really seen this become too much of a problem yet. I foresee this won't really become a problem for retail users, but when it comes to institutions, they want to stay as far away from sanctioned addresses and sanctioned assets as possible. And so they could be in a tricky situation where they don't want to touch these whatsoever. But pretty interesting to see Chamath get into this. These guys, I listen to All In sometimes, Chamath and Jason and David Sachs and these guys, they hop on the podcast. I hear Jason talking about Tau, all the time. It's pretty compelling to hear how Chamath thinks about privacy coins and is taking a particular interest in Zcash. And I think a lot of people are going to continue to do this. And also, if you just look at the raw outperformance and the flows here, Zcash has tremendous relative strength relative to the rest of the market right now. Guys, let's keep moving. We've got a lot to cover before we bring Andre Cronje up for Stabled Up. So we're going to keep moving along. I know we want to get into daily equity, our daily equity show. But before we do, we're going to give a shout out to LeFi. LeFi is building infrastructure for cross-chain swaps, bridging, and routing to across the on-chain economy. These guys are doing fantastic. Again, liquidity infrastructure to support the ecosystem at large, especially as we get this tokenization super cycle bringing trillions of dollars in assets on chain. They're going to need to find a home. LeFi can help bring those assets exactly where they need to go anywhere across the on-chain ecosystem. Guys, this was pretty cool. Ansem saying that token buybacks are not enough. I find this kind of research compelling. These are great perspectives. You might have your opinions about Ansem and his token, but I tend to enjoy when we have these pieces of analysis. Token buybacks cannot rescue weak valuations. Crypto trader Ansem said token buybacks do not necessarily provide lasting support for valuations, pointing to the sharp gap between Hyperliquid and Pump Fund. We were talking about this a little bit earlier. Hyperliquid, something like, what is it? Fully diluted 65 billion versus 1.4 billion in fully diluted valuation for Pump Fund. The two platforms, Hyperliquid generates 800 million, Pump Fund 440 million. So yeah, here's the gap. I mean, they're generating, Hyperliquid's generating about double the amount of annualized revenue than Pump Fund, yet Hyperliquid carries a valuation almost 30 times, more than 30 times that of Pump Fund. And so what is this gap? Why does this gap exist? Ansem argues that Hyperliquid consistently rewards core users while Pump Fund's still unfulfilled airdrop promise has weakened its trust premium. Trust is a very fickle thing here in crypto. We've been through multiple cycles. We see how mercenary capital moves throughout the space. I was chatting with another DeFi team that prioritizes buybacks, and the way that they explained it is that verifiability is crucial when it comes to these buybacks. The markets always want to be forward looking. So just saying, hey, we've done this amount of buybacks in the past is not enough. The community, the investors, right, the investing community as a whole wants assurances going forward that there's going to be buybacks in the future. That is what the market is looking for a continuous bid on a particular asset. And so my understanding is that Hyperliquid, you basically have this assurance, right, that 99% of the revenue in the Hyperliquid ecosystem is going to flow into the Hyperliquid asset as in the form of buybacks. They've made this clear. You can see it on chain. They have these verifiable assurances that this is going to take place. I might be wrong, guys. In the chat, feel free to correct me, but my understanding of Pump Fund's buyback model is it's kind of like trust me, bro. It's kind of like when we want, if we want, we might take it away in the future. You don't really know when it's happening or how it's happening, but we're going to do buybacks when we feel like it. It's very informal. It's very lackadaisical. It's very much like up to Pump Fund. And you don't really get the verifiable assurances in the Pump Fund buyback model that you get in Hyperliquid, right? And so if I'm an investor and I see, two companies with relatively similar revenue profiles, but I have this, not just this trust, but this verifiable assurance that one of those companies is going to be taking that revenue and accruing that value into its asset, that's the company that I'm going to go with. And right now, Hyperliquid has that. Pump Fund doesn't have that. And there's very few companies that have that. But that's why we're seeing a concentration in the assets or an investment concentration in those assets, right? Hyperliquid falls into that category of verifiable assurances. I think very few other ones fall into that category. But just to name a few, Aerodrome has this verifiable assurance. We know day in and day out the revenue that accrues in the Aerodrome protocol is going to flow verifiably into the Aero token. Similarly, I think Near, I talk a lot about Near because I think they're doing great work, but they also have this verifiable assurance. I think Alex Shevchenko came on the show and he said they've got this model where a certain portion of the revenue flows into the token every single time. From Near Intense, I think it's almost all of the revenue. And then when it comes to the protocol, because there's different products, some of that revenue flows into the Labs Corporation. But there, again, verifiable assurances that this revenue flows into these tokens. The other one, which I got to give a shout out, because I was unaware of this, but I've seen their token perform well over the last couple of weeks. And I think this is the reason why, is Maple. So Maple Finance, we had Joe come on the show. We asked him about the revenue profile. He said that they're doing about $1.25 million a month in revenue, but they have these different buckets, right? And they said, okay, anything between $1 million and $2 million. I think it's like 25% of, and I don't want to, you guys can go back and watch the show with Maple to verify these numbers, but I think it was maybe, say 20% of the revenue between 1 and 2 million goes into the token. Between 2 and 3 million, maybe it's 25%. And then between 25 and, 2 and, maybe upwards of 5 million, more so, that is when, there's even more revenue that flows into the token. So that is, another verifiable model that you can use to determine how much of the revenue that these companies generate is going to end up accruing into the token. But that's what the market is looking for. I think that is another way of painting this trust premium that Ansem is talking about. The market is going to reward verifiable assurances in the tokens that we know that this value is going to be flowing into those assets. Let's continue. We've got about 2 minutes before our next guest joins us. And so we are going to chat about Eric Balanchunas, the ETF guy here, T Rowe Active ETF. TKNZ is live today. First multi-token active spot ETF. They've been around for a long, long time. Fees 75 basis points, opens with 15 million in assets. And here's the holdings to start, which show underweight Bitcoin and overweight most of the rest, especially hype. Let's scroll down a little bit to see what the breakdown here in this fund is. Obviously, they've got Bitcoin and Ethereum. Let's scroll down a little bit to see the rest of this. I believe they've got Hyperliquid in this as well. So Bitcoin and ETH, Binance in here, Solana in here, XRP in there, and then Hyperliquid in there as well. And so is Eric Balanchunas saying that this is the first indice ETF that we have that's tracking a basket of crypto? It's pretty cool if that is the case. And so, yeah. Pretty cool to see this. And so, man, I do think that we're just going to see more institutional investors, which is pretty fantastic. I think this is going to open up access. What else we have in here is, the fact that Solana, XRP, Binance are in here. I just, we're going to get more creative in terms of the basket of assets that are chosen to represent these indices. Obviously Bitcoin is in here, ETH is in here. If anything, I think Hyperliquid is a, pretty underweight represented here. But I think, again, like if I'm creating an indice, and I think, you guys saw the N7 index, that's our Neo Finance index. And we've got the likes of EtherFi and Hyperliquid and some of the other revenue producing companies in there. And we're going to revitalize that a little bit more. And we're going to do some adjustments in the N7 index because there are real coins out there generating real revenues and accruing that value to the tokens with a verifiable assurance that the revenue is going to be flowing into the asset. And remember those are the assets that we're prioritizing. And so again, like if I think about it, Solana, I think about some of these assets like a pump fund, it's not enough to just have revenue, and it's not enough to just, have like this large network model with a lot of activity. I want a verifiable assurance that the revenue that, one, that they're generating revenue, two, that they have this revenue flowing into the token. Those are the two criteria that I have for where I'm allocating, because those things exist. We haven't had those in any other time frame. Now that those exist, that is where I'm allocating capital. All right, next up, we've got our daily equity segment. Let's get into it. Play the animation because we're going to talk about some tokenized equities because they're continuing to rally. All right. The Kobayashi letter, I feel like this is just our daily equity every single time. The current bull run is historic. Guys, people were calling for the top last night when Trump said that China was fiddling around in our elections. People were scared. They were concerned about what this could mean for the equity market. Things still seem pretty, okay for the moment. But again, and then we also had Kimi K3 that got announced. Token consumption is still pretty high on that, but people were looking at what this could mean for memory and semiconductors, and so we are watching that very closely. The S&P 500 is up 95% since the end of 2022, placing the current bull market within the strongest 10% at this stage of the cycle. By comparison, the top 25% of historical bull markets gained roughly 50% over the same time period. Man, this sounds like we're, what this is trying to suggest is some, entering of euphoria. But again, we've talked about this in the past. We've talked about how, the multiples on these companies, on these equities, is still relatively reasonable. I think something like an average of 25x, once you get above 27x is when I think it's a little bit overheated. We're not quite there yet. These companies aren't really overvalued relative to their revenues. The question, of course, is how durable are these revenues? But again, you look at that, and then you also, we talked about earlier in the week how households have the largest amount of cash on hand that they've ever had. So yeah, the market's up a lot, but these households also have a ton of cash. So it feels like there's a lot more room to run. By comparison, 25% of the historical bull markets gained roughly 50% over the same period. Meanwhile, the medium bull market delivered just 35% after 3.5 years. Current bull run has remained within the strongest 10% of historical bull markets for 2 years. If you exclude the March-April 2025 correction, since the April 2025 low alone, the S&P has surged 51%. Incredible. Guys, the S&P is on a historic run. The question is, how much longer can they keep this up? That is the question. I think they can keep it up for a little while. I mean, it's a little bit concerning to hear, oh, things are so good right now, because, it tends to imply that things can't stay this good forever. But when you really look into the nuts and bolts here, there's just this continuous rotation happening. And so it's not like we're getting this rates are much higher than they were for a long, long time during the ZERP era, right? We were close to zero. We actually have room to cut if necessary. And so it actually feels like the market has some breathing room. It's not overheated. The labor market's doing okay. Inflation is coming down. Multiples aren't super high, and there's a lot of cash on hand and dry powder from a lot of investors. And so, maybe you're due for a correction, but it just doesn't quite seem like we're in this super overheated market right now. Looking at this year 1, 2, 3, 4. We obviously have seen a correction in the crypto markets. I think, people have been looking at the correlation between the crypto native assets, digital assets, and equities. They've also said that the time in which, people typically say that digital assets are the most reflexive asset class. And so that would lead us to believe that it will recover quicker and react quicker to evolving market conditions. What that means is that if there's a correction in the equities market, you would expect digital assets to bounce back first before equities do. But again, we haven't seen that correction in the equities market. Little Miss Gunn, appreciate you rocking with us in the chat. We just haven't seen that correction in the equities market. And so there could be this inverse correlation between the equities market and the crypto market that we're seeing play out right now. I think if equities do correct, initially that's going to be negative for digital assets, but over time, digital assets would react first to the friendlier market conditions that would come as a result of that correction. So that's what we're seeing playing out on the equity side of things. We're going to continue to monitor this. And for now, things seem to be okay, but we're watching this closely. Let's keep moving along. I think we've got one more tweet that we're going to cover before we get Andre Cronje up. We're getting him ready in the back. And we're going to cover some more news in the tokenization space. So let's go ahead and bring it up. We're going to be talking about Alpaca and the raise that they just had. They just announced a $135 million raise led by Peak Partners. Major participation by Ellie Fund, VC, and additional new and returning investors from Opera Tech, venture capital arm at BNP, and Unbound. Guys, Alpaca is doing some very, very good work in the tokenization space. For a $135 million raise, it's flying under the radar. These guys underpin a lot of the tokenized equities conversation. And so if you haven't really heard a lot about Alpaca, I'll tell you a little bit more about them now. They have this $135 million equity round that brings their total financing up to $435 million. We talked about who their investors are. This capital, they said, will support Alpaca's expansion of agent-first brokerage APIs for tokenized global markets. So they are leading the charge on tokenization. Obviously, we've seen quite a bit of RWA tokenization up till now. We've heard a lot from the likes of the Robinhood folks that are, doing this tokenization on demand mechanism. So they've raised $135 million. They talk a little bit more about it here. And like I said, $435 million in total financing, including the raise and debt financing, primarily from Payward, the parent company of global digital asset platform, Kraken and BMO. So Kraken is heavily involved here. We expect Alpaca to continue to facilitate the tokenization super cycle. This financing, like we said, will accelerate the development of their agent-first brokerage infrastructure. So they're going to get APIs that agents will be able to use to execute transactions. They're going to help financial companies build, launch, and scale investing products worldwide. The milestone builds on their business growth, highlights the strong execution they've had this year. They acquired the registered broker-dealer, and they have finalized the acquisition of the UK and European entities. So a lot of regulatory capital being deployed, doubling revenue every year over year for the third year in a row, surpassing $1.5 billion in assets under custody for the underlying stocks backing tokenized equities. So that is the primary role that Alpaca plays in the tokenization market today. You guys have heard about how massive the tokenized equities market is. Alpaca serves as one of the primary custodians for the underlying equities. And so the underlying stocks backing tokenized equities is where Alpaca fits in. They effectively hold these, and then they facilitate the tokenization of these equities. And so they have several partners in the space, monthly active API users increasing nearly 4x as they expand agentic AI capabilities. So execution via APIs, deep into this tokenized equity space, serving a role as custody partners for a lot of the tokenized equity players all across the board, in several different chains. Again, we believe that this is a massive, massive opportunity. We believe we're going to hear and see a lot more from Alpaca. And so we're going to continue to watch closely at what Alpaca is doing as they pioneer tokenization super cycle and tokenized equities. Really, really nice positioning at the cross section of two accelerating narratives. Guys, our next guest, you guys know him well. Andre Cronje. He's a systems architect. He's one of the earliest builders in DeFi. He created one of the first DeFi yield vaults. He is now working on Flying Tulip. And Flying Tulip, we're going to get into and talk about more today. They had a very, very interesting launch model where they initially raised some capital for this. I like Andre because he has a lot of crypto native ethos to him, and he hasn't been institutionalized like some of the other guys that are out there. So things in a very creative, very unique way. I'm excited to have him up on the show. Guys, this is going to be Stabled Up, episode 41. We're going to bring up Andre in just a moment. Let's go ahead, play the animation, and let's get him ready in the back.
Welcome back to another episode of Stabled Up, our premier weekly show covering the ins and outs of digital dollars, stablecoins, and the future of decentralized finance.
The show is made possible by Frax, and Frax is powering the financial engine of the internet, powering FRX USD and Genius compliant stablecoins. This is the stablecoin super cycle made possible by Frax. Now enjoy Stabled Up, our weekly stablecoin show. Here, very unique launch strategy here.
Long ago I was on your, or at least it doesn't feel that long ago.
I think it was just a few months actually. What have you been up to?
Rollout mostly, trying to get products online as quickly as security allows, and hopefully as fast as investors want, which is always a interesting tug and pull game, I think.
Do you find yourself wanting to ship faster than investors want you to?
No. I mean, investors always want everything live yesterday. Security is always the biggest constraint, because it's audits is one thing. I think while audits are very important, they're a little bit overplayed in this space, and not overplayed. Too much emphasis is put on only audits, and then a lack of, infra security, key security, secondary order securities, things like circuit breakers or outflow monitoring. And those things take time, like capped launches, slow approaches, and it also creates user friction, which in itself isn't nice, because you end up limiting what your users can do at any given point in time, and that also, prevents scaling.
Yeah, I just saw there was a recent, I think it was a vulnerability on Ostium, the perp DEX, and $18 million left the protocol like that, and people are calling, that's why circuit breakers exist. They're a feature, not a bug.
Historically, circuit breakers didn't really make sense because there were only two interacting parties. It was the depositor and the smart contract. There was nothing else. There was no multi-sig. There was no, off-chain counterparty. So we've inherited a lot of the design principles of old DeFi into this new category where we are now, which is closer to on-chain companies than it is decentralized finance. So, back then, if you had a smart contract and someone could not have instantaneous liquidity, you'd be dead in the water right off the bat. Nowadays that you have, a line of communication, a support channel, people you can reach out to, I think the assumptions are very different, and circuit breakers now make sense as well, right? Because circuit breakers are there, and our system is also multiple layers of circuit breakers, and I've seen the friction it causes for users, because a user might be used to, or the fear it can cause, right? Because using our circuit breaker as an example, when you request the funds out, it goes into a queue, and then you can claim it in 6 hours. But now, myself, sometimes while using the system, I'll claim it, and I'll go check on Etherscan, and I'll see, it didn't go to my wallet. It went to 0xCB, which is our circuit breaker.
I've seen this.
But, in my mind, I'm like, holy crap, what went wrong? Meanwhile, it's just sitting there waiting to be released so that I can claim it in a few hours. But something as simplistic as that, causes fear and panic from a user's perspective.
Yeah, yeah. And hopefully we can solve some of that with UX developments, right? And a lot of this is, going to be obfuscated underneath the hood. And, I think one of the building principles that I've heard from developers as of recently has been, look, we're building for the next cohort of users, not necessarily the crypto native ones that have been here and are the most sophisticated. We're okay with sort of showing something on the UX side, right? And on underneath, right, we know that, it's in the circuit breaker, it's going to get claimed, but we're going to show the number as if it's, still with the user, because ultimately it will be, and sort of maybe take some shortcuts that, back in, the more the DeFi purist days wouldn't have really been within the realm of what people would have been accepting.
Yeah, I mean, back then, if again, if your counterparty is just a smart contract, I think it's not too much for the user to expect that they have instant liquidity and instant access. That's a fair ask if the only thing I can talk to is the smart contract, because I can't queue a transaction in the smart contract and then ask someone to expedite the queue for me, because in some cases you do need to do that. So I think the old age fight between security and user experience is as old as time. I mean, it comes down to, you can have a password of 123, which from a user experience side is more convenient, but much less secure. So what did they start doing? They started enforcing more and more complex passwords. Now you need at least 8 characters and, alphanumeric capitalization and some symbols. That's a lot harder to remember, but it enhances the security. So security and UX will always fight with each other.
Yeah.
I think this is just a part of the space maturing, where we're starting to realize, look, we have to start including these small UX frustrations that ultimately provide a better order of magnitude in security. Especially as, and this is again a huge difference between, sort of 2020, 2021, or even earlier, as early as 2018, decentralized finance, which was, the goal was pure immutability and pure decentralization.
Right.
Nowadays, I don't even preach that anymore. If I work with a new team and they ask me if they should have their contracts upgradable or immutable, I always tell them upgradable. I think it's non-negotiable nowadays. You have to be able to upgrade your code. But that immediately means you have the biggest threat vector known to your entire protocol. Because if you have one developer key that's sitting on some guy's PC, and he's able to unilaterally do an upgrade call on that contract, that can steal all of the money. So now you already have to make sure there are, and this is why I say, smart contract audits aren't what they used to be. They're still majorly required, but the best audits in the world won't capture that vector. So you need traditional security infra now as well to make sure, hey, the key is properly offsite, and probably some HSM signing, or ideally the deployer key should be immediately handed over to a time lock and a multisig. But even therein is now again a different trade-off consideration that you need to make, because if the contracts are fresh and you just upgraded it, you might not want the time lock, because you might need to be able to respond within a fairly short time window. Yeah. Now, if something goes wrong, you can't wait 72 hours to do an upgrade or a freeze or something. So, so your contracts can't just be a single admin role, and that admin is a time lock, and that time lock is in a multisig. So, using ours as an example, anything that moves money sits behind time lock and sits behind a multisig. Anything that can momentarily pause or delay, so something that can either drag out the circuit breaker a little slower or pause funds outflow, that can't sit behind a time lock. That we need to do in collaboration with, and I mean, there's some great teams out there that we're also trying to still onboard, Hypernative, Seal 911, obviously. So you know, now all of a sudden, from the base code level, you need to start thinking about this role separation and how these separate roles can sit in their separate areas.
Yeah. Yeah, I think, this is one fantastic observation, given that you've been, in the space, you've worked on multiple projects, you've got the benefit of hindsight and learning through the iterations of some of these things. And, there's been several iterations that the space has gone through, philosophically, which calls for different design choices, both on the security front as well as on the UX front. And as you said, these things are constantly at odds with one another. As we, we'll get into Flying Tulip and kind of the nuts and bolts there and all the updates. But I'm just curious, before we dig in deeper, some general observations that you've had. You mentioned auditability. You mentioned sort of this dichotomy, security and UX. Some of your projects, you've worked on, they're continuing to run. What have been the lessons? Like, what are some of the observations, the general shifts and evolutions that the space has gone through that you're now putting into into practice with Flying Tulip? In addition to auditability and security, what else have you noticed about the space that's changed since, the good old days, if you will?
I think the most important one is decentralization is dead. We're no longer striving towards decentralization. If nowadays, and truth be told, I think this shift even started happening around probably towards the end of 2023, maybe even 2024, because something like Yearn's fair launch, which, the so-called immaculate conception, like from the get-go, I designed it as a mechanism of decentralization, which is why, I didn't have tokens. Everything was given away to the protocol users. There was no team, there was no foundation, there was none of those allocations. The goal there was decentralization, right? It was trying to as closely copy the Bitcoin playbook, where the original founder leaves and a community has to take it over. That today people won't be interested in. People won't want that. They need someone behind it that keeps driving value, because the tokens have become almost too valuable, to the point where the person holding the token, this is also just an evolution of the user base interacting with blockchain and crypto as a whole. Because back then, the majority of users were, technocrats, or at least technically educated people, and they understood the token's value beyond it as an investment vehicle. And I think nowadays everyone sees it first as the investment vehicle, and second as a utility-based something or anything like that. Another example of immutability being dead, is something like the decentralized keeper network that we built originally for Yearn and Maker and a bunch of the stuff that was using it back then. That was again moving towards A, decentralization, and B, immutability, in that it was designed as a marketplace for unknown actors to be able to work jobs and provide facilities on chain. Again, nowadays, everyone just does their own infra off chain. They run their own bots, their own keepers, their own liquidation systems. It's not about trying to do it on chain anymore. It shifted more and more off chain. And then lastly, immutability used to be a feature. Nowadays, I think it's a bug. In that it doesn't, because now if you combine all of this, so you combine a new base that are looking at these things as an investment vehicle and no longer as a utility-based thing, you are looking at teams that have to run more and more of their own infra off-chain, which means, there's AWS or Google or Hertzner or wherever you're hosting, but there's bills to pay, right? I mean, apps, again, back in the original DeFi, you'd throw up a UI on IPFS, people would access it remotely. You wouldn't be hosting servers and infra and stuff. I mean, the original Yearn ran entirely on-chain. There was no off-chain server. There was nothing. The only thing I paid for was the domain name. So that won't work nowadays because people need that extra usability, they need that access, they need that support channel. And the second you need to provide all of these second order functions, that's not just smart contracts, the team needs to be appropriately incentivized. You need to be able to pay salaries. People need to be able to stay on board, understand the vision, and want to see the vision beyond, a 2-year vesting term.
Yeah.
So I think it's drastically changed. I don't think it's comparable at all. And that's why technically I'm actually a little bit against even still calling it DeFi, because I don't think we're anywhere close to DeFi. I generally, when I talk to people, I call it on-chain finance, if I do call it anything, which is closer, because it's normal finance. It's just we do things on-chain. That's the big difference.
Yeah, we call it neo finance, which is effectively the same thing because it's not decentralized. You're absolutely right, but there are certain functions that take place on chain, and then there's a whole amalgamation of functions that take place off chain, and users are just okay with it now because of a combination of things. People have gotten burned, right, as a result of just code is law and not knowing any better. And also the cohort of people coming in, they rely on some of the functionality that they've become accustomed to, and the consumer behavior calls for, customer support channels and forgot password buttons and these sorts of things. And so these are the design principles that they've come to expect. And I think, maybe there has been this, kind of this acceptance rather than, trying to beat the drum and explain decentralization to people and expecting them to come to us and learn and adopt our principles. We've decided, no, we're going to meet people where they are for the benefit of the adoption of this technology. We're going to build with their consumer behavior in mind, and we're going to, make the design choices that, maybe sacrifice a little bit on our own principles, but as a whole, everyone is somewhat better off because something is better than nothing.
In principle, agree. Yeah, I think the gap comes in that we still have a lot of actors trying to sell it as if it's decentralized finance, as if your counterparty risk is only the smart contract. And I think that disconnect is where the risk comes in. It's because I mean, a perfect example is this new generation of curated vaults, right? Like they would have you believe that the trust assumptions is the same as the old 2020 Yearn vaults, as an example, where there your counterparty was only the smart contract and the downstream, whether it was Aave, Compound, etc. Nowadays, it's still happening on chain, but your counterparty is a curator. It's off chain. It's potentially a credit facility. It's potentially some non-liquidatable on-chain RWA or some IOU. But if you go and deposit in that vault, it's still kind of being presented as your counterparty is just a smart contract. So, and the same is true for tokens, right? So, I mean, if you were to have a publicly listed token somewhere, there are very specific requirements in terms of disclosures, compliance, public audits, these kinds of things that are required. And we're trying to play in that space, but at the same time, we're still kind of avoiding that level of reporting and transparency, etc. So, and don't get me wrong, I don't think, generally speaking, it comes from a place of malice. I think it's a transitionary period that we're currently in, where it is the old DeFi engineers that are now building fully fledged businesses, and it's just going to take time.
Yeah.
But I do think there is a little bit of a disconnect in terms of what is being presented versus what it actually is.
Yeah, I think that's right. And so, I mean, you mentioned, some of these curated vaults as an example, and, I'm sure we can dig into more of those, but I'd love to dig into Flying Tulip as well. And in terms of, how you've been able to, build Flying Tulip in such a way that you've attempted to, make the most of these design choices, because, you're right. We're not in this DeFi purist, era anymore. And we're also in this transitionary period where we don't have full, clarity, regulation in the US, or just full market structure, regulatory clarity. And so there's sort of this transitionary phase, and it's still, trust me, it's not as bad as, the Gary Gensler era in the US, but, we've still got a long way to go as well. And so, when it comes to some of these design choices, and let's, just, for the sake of honing in and understanding, stick to the lending and the vault space. Maybe you could just first give us a general understanding of Flying Tulip, and then we'll get into the design choices that you've made, and maybe how you see the vault space, and how you've been able to, observe and implement some of these learnings into the product.
The product itself, the suite of protocols that Flying Tulip really is most simplistically, it's the composability of a lending market that can directly feed into an order book, so that it offers, trading and leverage. That can directly feed into derivatives, insurance. And then we have our settlement layer, which is our native stable coin, the Flying Tulip USD. It almost makes more sense why it exists and why it is the way it is if you go back to, again, the premise of original DeFi. The original contracts, one, immutable, two, because there was no direct teams involved, there weren't any fee extractions. Again, using the original Yearn vaults, it took 0 fees. So it was easy to build on those protocols because you knew the code was going to stay the way it was, and you knew that there weren't fees. Nowadays, you've got Uniswap v2, v3, v4, you've got Aave v3, v4. There's almost always, and they have to, because they've become proper companies, so they need to A, be able to continuously upgrade and deploy new systems, and B, be able to charge fees, because they have to pay the people who are supporting these things. But that essentially killed composability, because that meant, because I could build a margin trading system on top of Aave, because all you're actually doing is, let's say I want to 10x leverage long BTC. What you would do is you would take a flash loan out of USDC. You would then, on whatever trading venue you could, let's say Uniswap, you would trade the USDC to wrapped BTC. I would deposit that wrapped BTC into Aave. I would then borrow that amount of USDC and repay the flash loan. Now I have a 10x margin position in Aave, but there's no incentive for anyone else to build that, because the fees are all going to Aave. And if Aave then later on upgrades their system, then same problem, right? I have to now redeploy and rebuild the whole system. So a lot of these features that we've combined in terms of composability is really just because the base layer, which is in the permission world, the base layer is the lending market. In the non-permission world, it's actually the AMM, which is an interesting distinction. It needs to be aware of all of the things that's going to be built on top of it. Not necessarily in a it is already built methodology, but at least in a terms of I am building in such an open way that these things could in future integrate into me. And that's also a design element that's you really don't see nowadays in on-chain finance anymore, because everyone is kind of building to protect their moat, which also makes sense because it's businesses now, right? So you're not really building with other people are going to build on top of me in mind anymore. I think those days are largely done. But that left a massive gap, right? Because one thing, and this is actually something I wrote about many, half a decade ago at this point, which was back then called dairy swap, derivative swap. It was just one Medium article and it was just a concept, but then Gensler came in and kind of ruined all chances of launching new stuff. So as you say, the space is definitely better off. But the concept was simple. The concept was, why can't idle liquidity sitting inside of a lending market at the user's choice be deployed into a single-sided liquidity position? Or if it is already in a AMM, why can't the liquidity not being used in the AMM be deployed to a lending market? You know, and we've sort of seen people try to do that, right? Because you'll have, again, using Aava and Uniswap as the example, nothing stops someone from going to Uniswap and launching a USDT, a WBTC, which is Aava USDT and Aava wrapped BTC pair, and depositing that into the pool. The general problem there is that if I, as a user, land on Uniswap's front end and I want to trade BTC to USDT, the engine doesn't know that a WBTC and a USDT actually represent the underlying assets, because it only sees the tokenized version. Now, aggregators have done a lot of work to be able to integrate those custom routes. But now I'm already talking about so many hops, right? Like I first have to go to Aava, deposit the stuff, then to Uniswap, then get this stuff, then an aggregator, then set up this route. And if we were on that original sort of immutable and feeless and composable world, you wouldn't need to do it that way, right? It should be as easy as a tick box that says, yeah, cool, I want to opt in my liquidity for this. And that's the opportunity that's always existed, that I've always been like yearning to exploit. And that's where we're at now, right? Is we've started with the margin accounts. And now I'm probably getting a little bit too much into the weeds of the program.
No, this is great. This is great.
But another thing, for example, is LTV does its job well in old decentralized markets. So our lending market, and I'm even hesitant to call it a lending market, I generally prefer to it as margin accounts. Our margin accounts use an equity-based system similar to a margin account on an exchange would. So it compares the equity of your account. You know, that takes into account your P&L, that takes into account if you have netted assets like staked ETH versus ETH, staked Solana versus Solana. That takes all of these extra things into account, which gives you a much more robust position than just LTV. Because just off of LTV, and this originally actually started because USDE, Athena, which is the first time I even started discovering about, you know, delta neutral yield farming, essentially. But I was always frustrated that you can't do what Athena does off-chain, on-chain. And the more I tried to kind of discover why, it's because you can't, due to the nature of loan to value, LTV, you can't hedge your delta away. Because if my staked ETH is 90% LTV, there's always that 10% margin I can't get rid of. So it has to be 100 to 100. And you can't do that with LTV, but you can do that with equity-based accounts. So, you know, there are also a plethora of these more granular innovations that I think as a whole are also a step forward in the industry. Another small thing, you know, is when we do a trade on our own system, it doesn't just hit our order book. It automatically creates a RFQ order, and that RFQ order goes out and hunts the entire blockchain for liquidity. So if it can give that user that wants to facilitate that trade a better quote somewhere else, we want to give them that quote. Because it's too often that, if you go onto the specific AMM's website and you do a trade, you're just going to be trading against their pools. And that's not necessarily what the user wants. Now, it gets fixed again because the responsibility is kind of shift onto the aggregator, but at the same time, it shouldn't need to. There are lots of these little micro innovations we can go through. Another one I'm really proud of is actually that our liquidation system itself is RFQ based. So it's not just, you repay the debt, you get a chunk of the collateral. It's, hey, here's the collateral. An RFQ goes out, give me a bid. And whatever the best bid is what ends up getting sold. So, I mean, we've had, it's unfortunately bad market. So there's been a lot of liquidations on the system, and almost always our bad debt the liquidatable debt, not bad debt. The liquidatable debt is repaid dollar for dollar without a haircut to the user. It's small, but these little things add up. But look, all Flying Tulip's mission statement really is that there is no reason that every blockchain, whether it's a layer 1 or a layer 2, shouldn't be a fully featured centralized exchange, right? If you go log into Binance, Coinbase, Kraken, whatever else right now, you can do lending, you can do yield vaults, you can do spot trading, you can do margin trading, you can do hedging. And that's the mission statement, right? It's having the central entry point where you can deposit funds and then offer you all of these features while giving you the best yield, capital efficiency, and composability. Because again, something simple, right? If you can place a limit order on our spot system, that limit order of yours is earning yield because it's in the margin account being lent out on the other side. So there's never a point where your capital isn't put better to work. But anyway, I'm feeling a little bit too pitchy now, and this was not the goal.
I understand. I think you're also talking about design choices in general that these chains are making, and I think you've gone and decided and built in this direction with Flying Tulip. But the most recent example of this is Mega ETH, right? They sunset their Mega Mafia cohort, right, of third-party applications, their incubator that they were doing, and now they're going and building first-party applications, which is what you say every chain is going to end up doing, whether it's an L1 or an L2, with some of these features in mind, because ultimately we've learned through so many of these chains, these are the primitives that people want, and it just makes sense that we have a more composable world of each of these functions on each of these chains. I want to get into the stablecoin element of Flying Tulip. It's something that you didn't talk very much about, but it's a core component, and this is our stablecoin segment on the show. So I want to talk about that. Before we do, I just want to close the loop on one thing that you mentioned earlier, which was an interesting point. You mentioned how the core base of these composable systems in the traditional world was typically the lending market. And I think that was mostly because of the margining profile, and you were able to run, and now you've actually implemented this equity margin-like account on Flying Tulip. And that's sort of, the base account that gives way to most of these features. But on chain in the past, it had been these AMMs. Right. And so I'm just curious about the distinction. Why was it the case that it was AMMs? And why did you choose to include this equity provisioning account on Flying Tulip, more akin to the traditional world than the on-chain native world?
So, well, the answer there is that it's still both. Within Flying Tulip itself, we have two distinct verticals. We have our permissioned set, which is the one we launched first because it's easier to control. So the benefit of the permission set is that it's cross-collateral. So I can onboard BTC, ETH, USDC, all in the same margin account. The problem with that is every time you add an asset, you are implicitly exposing the entire existing book to that same asset. And that's true for any cross-collateral system. Every time Aave adds a new collateral asset, it's automatically exposed to the entire book. And we've unfortunately seen the downsides of that. But that means it can't work in the permissionless market, right? Because if I now want to, sorry?
You're referencing like Kelp DAO and like how, just the RS staked ETH exposed like potentially the entire ETH book on Aave and these sorts of things?
Unfortunately. Now, don't get me wrong. I don't think that was a bad onboarding choice or curation choice or anything of that. I'm just saying that the second you onboard these assets, you are implicitly exposing your entire credit facility to them, and that hurts for other depositors.
Yeah.
But now, let's say someone wants to, come launch a new token, and they, of course, can't automatically be part of that cross-collateral margin. So our permission, so the permission set, the first entry point is the lending market. On the permissionless set, the first entry point is actually still the AMM. Because if it's a new token, you have a few problems. Problem number one, it doesn't have an oracle. So I can't just pull, something from Chainlink or Redstone or even just CoinGecko, right? And sign it and post it on chain. So I don't have that to work with. Thing number two is I don't know things like liquidatable depth or what kind of trade facility or I should offer or how I should quote this asset even. So for all of the, but you can solve each one of those pain points individually through the AMM itself.
Yeah.
So our permissionless markets start with you launch your normal AMM, which is two pairs, right? That's just your asset and ETH, or your asset and USDC, or your asset and whatever else. As that starts trading, it starts building up your Oracle data, which is your TWAP, your time-weighted average price. And then it also starts building up something that I always found lacking in this space. And it's something I actually included in the original VE33 designs. All of those VE33 protocols actually all have this, but I haven't seen any of them use them yet. And it's something I call TWAR, which is time-weighted average reserves. Because if something is priced at $3, but I can only sell $1 of it because there's only that much liquidity, then its price being $3 isn't actually its price. Its actual price is how much can I sell this for. So more important to me in the DeFi space was time-weighted average reserve. Now, all AMMs have a A and a B reserve. So that's the number I actually want, because that number means that at any snapshot in time, I can ask the AMM, hey, how much can I liquidate this position for? Now, normally you'd assume, hey, I can just, ask it in real time. Why do I need to keep this historic metric? But that's unfortunately the world we live in with flash loans and LP manipulation means that you can never ask a question in real time. You always have to have a historical snapshot of the question. And even if you do ask in real time, I need to be able to compare to some historical point that I can see, is this a good reading? Is this a bad reading? Is someone manipulating? But the question you need to answer is how much can I sell? And the reason, if you work back from that question, the implicit question to that one is how much can I liquidate? So we actually end up using the time-weighted average reserve output to see what kind of LTV I can offer the user. Because now the same AMM pair, let's say it's X and USDT. Now that same pair facilitates lending. So the user can provide their X as collateral and borrow their USDT. And their LTV is based on their X position relative to the pool. So it's not a fixed value. It's not you have a 50%. It's if you're a very small bit of the pool, you get a very high LTV because your impact is low. If you're a big part, you get a low one, and inversely. The next thing you need is interest rate models because you don't have that. So the other thing that these AMM pools track is the moving averages and the volatility. Okay. The moving averages and the volatility also influence the curve at which we quote the price. So assets that are completely flat in terms of volatility are priced on the X3Y curve, which means it's basically a stable coin. The more higher that volatility is, the more it veers towards the traditional Uniswap XY. And then anything in between it allows for. And this curve in itself, I also need it because it facilitates Forex trades, because stable swaps or XY don't really work for Forex trades, because it's low volatility, but it's not no volatility. So that also sits on this curve. So this curve, the pricing between the reserves is also influenced by the volatility and the moving average. The interest rate is also, because in the lending world, you really have two interest rate models. You have volatile, you have three. You have volatile, you have major, and then you have stable. And that's, again, answered by volatility and your moving day average. So now I can offer lending and I can already offer trading. I have all the data points I need to be able to set up these positions. And then the last thing you can do from that is you use the work from GMX and their GLP to allow that same LP to be the counterparty for derivatives as well, so that you can take a long or a short against that position. And because you already have the lending market built in, now you can do leveraged positions as well. So when it comes to pure
permissionless
single asset pair permissionless, so anyone can launch this on their own. They don't need to interact with us at any given point in time. Then your starting base is still the AMM, and I don't think that's ever going to change, because that's all of your data.
Yeah. I mean, this is fascinating stuff. Like how you essentially, you're given, a single, primitive, and single is maybe a little bit too far. You've got a couple of these different interest rate models. You've got a couple of different AMM models, right? But from those base equations, you're able to build this entire suite of functionality. From the AMM, you're able to build the lending market. You're able to build the LP market and the perps market, all from this single AMM. And you're able to do it in such a permissionless way.
Only qualification I'll make there, is it's not a pure perp. It's closer to a pre-market perp, because the pure perps funding is obviously influenced between your external Oracle price and your mark price. Here you don't have it, so your funding is actually closer to open interest. How much are long versus short, and then long space short. So it functions like these pre-market IPO perps. So that's one small qualification I'll need to make, but other than that, it functions,
And
exactly
I mean,
the same.
that's also been the benchmark for, these low liquidity, early stage perpetuals markets. Like that is the same way that all these other markets tend to work. It's only just after, they do go IPO, they have some sort of liquid market price that's external to the book. Then you bring in that Oracle price as a means of sort of smoothing out what would otherwise be a rather, funky, Oracle price, because it's internal. Yeah, Andre, that's fascinating stuff. I really enjoyed just kind of walking through these things with you, and how you were able to illustrate the difference in building the permissioned stack versus the permissionless stack. So it makes a ton of sense. I want to be conscious of your time, but I also want to get into the stablecoin side of this. We talked a little bit around stable swaps and these sorts of things for low volatility pairs. But maybe you could just talk about the Flying Tulip USD, why it's such an important part of the overall system, and generally, how you foresee this growing as a core component to the book.
I think everyone will agree with the statement that we have seen stablecoins are the primary settlement layer and liquidity of almost every single big system we have. The original premise, as I said, came from Athena's USDE. It was looking for, hey, how can I do this leveraged delta neutral play on chain with LSTs? Because I also wanted to broaden it from just ETH. We obviously do SDETH on Ethereum and SDSS on Sonic, but I want to do Lista BNB on BSC. I want to do Hydrax, AVEX on Avalanche. Each one obviously has its own, and very often, even if you do these things in a centralized fashion, very often you can't, because that staking asset doesn't really count as collateral on most of these exchanges' margins accounts. So there isn't really a way to do that proper hedge. So that was from the outset kind of where we wanted to start with the stablecoin, is how can we do this leveraged delta neutral tokenization of the staking yield? And we couldn't. That's ultimately what it came down to. We needed something that you could properly hedge the position. So LTV was out right from the bat, and that started influencing, sort of. We first looked at LTV, but with standard netting, so that within the config you could say this asset is netted against that asset. So if they are, which it kind of looks similar to Aave's E mode. But you're still not going to hit 100%. You're going to hit 99 or something similar, and you need to be able to hit 100% to properly hedge your position. So we built the equity market, which is one of the reasons why we use the equity margin account. And so our margin accounts always allow that play. Then the other rationale of the stablecoin was as a mechanism for scaling. So it's normally pretty easy to get any given blockchain's native asset in a large amount, because there's a lot of liquidity for the native asset. So it's not hard to get a lot of people wanting to deposit, because there's also not a lot of yield opportunities for native assets. So it's generally fairly easy to attract, especially when you start talking to some of these digital asset treasuries and foundations and things. They have a lot to deploy. So we can get that easily enough. Now, the other thing you need is into your lending market is stablecoin liquidity. So maybe one thing, this will make a lot more sense. I should have actually started with that. So with something like Athena's USDE, what they are tokenizing is staked ETH as margin collateral, and that's earning you 2.4%. And then they are taking out the perpetual, so the derivative short, and then they collect that funding rate, which is, for argument's sake, 4 to 5%. It's currently, I don't think it's currently, it is probably still positive. And then minus fees and settlement and all of those things. So you end up with a delta around like 4 to 6%. Our lending market is not a perp market. The perps are getting activated later on, and then we will still do that standard trade. But for now, how we do it is we use the USDC and the USDT that is deposited into Flying Tulip USD, and that becomes collateral. So that becomes what we borrow the ETH against, and then we swap the ETH to staked ETH, and then the staked ETH becomes collateral as well. So the staked ETH and the ETH are still hedged, but it's grossly over collateralized due to the USDT and the USDC, and that allows us to leverage that loop as much as there is available deposits. But that means we're earning the 2.4% from the staked ETH, and that can safely be looped up to about 8 times with this design. So we're currently at about 1.5 because we don't want to push the system too hard, too quick. And it also depends on available liquidity, but you can. So that already will give you, 2.4, but you're still minus about 2.1-ish for every ETH that you borrow. So you net about 0.3, which that then at a 8 times loop, you end up, it's not 20, 30%, but it's still decent numbers. And then, the 3.2 to 4% that you're earning on the stable coins. And that gives you of your net of around like 11 to 12%. So that's how that delta neutral loop looks. And that's actually different than, the standard derivative based one. So the Flying Tulip USD is almost a little bit of a Trojan horse in terms of liquidity as well, because people deposit because they want to get the yield. By depositing, they're offering more stablecoin liquidity. Now our margin account has the 2 most important things it needs. It has stablecoin liquidity and it has the native asset. Almost all trades on any blockchain happen in either stablecoin or its native asset. So by having a lot of those 2, we can start offering very competitive trade rates in the spot or the margin or the RFQ. So we start onboarding those assets. More people do the margin trades, which means they borrow out more of the money. Interest rates go up. That influences the interest rate on Flying Tulip USD. So its interest rate goes up. It attracts more deposits, and then the kind of flywheel starts kicking in together with that. And that's even before perps are activated. Once perps are activated, then we'll do the standard carry as well as a secondary trade, while it's positive. But further, something like our total return swaps or any of our derivatives is also settled in Flying Tulip USD. And that's because we can do instant settlement with it if we can mint and redeem at any given point to close the trade. And then once the underlying is settled, we can burn again or mint again, depending on which way we have to go. So having that sort of mint and redeemability also gives that instantaneous settlement on the derivatives and things like the total return swaps, which is important. But then generally speaking, we also just want to offer the Flying Tulip USD as a ARB layer for once it is the base pair of more of our assets. Because if we can increase supply or contract supply based on mint and burn at any given point in time, we can always take that ARB as well and provide that profit to the user, since we won't have fees on it. And then lastly, your standard CDP model, allowing people to mint against it. But that's just another interest rate source of people paying, so that we can just diversify all of the yield opportunities on the Flying Tulip USD. But as you can see, it's a touch point everywhere. It's a touch point for lending. It's a touch point for trading. It's a touch point for derivative. It's a touch point for all of your trade settlements. So building that as an attractive offering is your liquidity layer for your entire system, and that's something you see with all of these perp markets, right? Like they always have these big, whether it's HLP or LLP or any of these other derivatives, they always have this one big stablecoin vault, and you can do so much more with that. There's so many more opportunities that you can place against that, and that also hedges you against, potentially when you've taken too many bad trades, or there's a bad liquidation or a bad Oracle feed or something like that. So it's. I mean, I'm hesitant to use statements like this, but it ends up being sort of the lifeblood of the entire system, because you need it running through all of these parts.
Yeah, and it's also the jet fuel, the initial gasoline to get the thing off the ground initially, because you walked through mathematically how it is possible to develop these components and stack them. Again, permissioned stack, permissionless stack. It is possible to create the functionality from these core components. But of course, if there's no liquidity running through these systems, then what's the good of the system? And so you walk through how important the liquidity in the system is to the system as a whole, and how the stablecoin helps to stimulate not only the initial liquidity, but it helps to perpetuate the liquidity as well as the system continues to grow. So it is, obviously crucial to the system as a whole. And it's also, correct me if I'm wrong here, but it also seems to be the value accrual, the destination for a lot of the things, a lot of the yield sources. These things tend to go towards, so because it's a touch point for all these things, it also tends to be like sort of this rewards or yield accumulation layer where a lot of that value tends to accrue.
100%. I mean, if there's settlement fees in the derivatives, it goes there. If there's liquidation fees, it goes there. If there's trade fees, it goes there. If there's lending interest, it goes there. So it, and again, it's kind of like I called it at the start, it's kind of the liquidity Trojan horse for the entire system, because it ends up having all of these different touch points. And I think we've seen that everywhere, right? Like the lending markets that survives are the ones that attract a lot of stablecoin liquidity. The trade venues that survives are that have a healthy stablecoin order book. The biggest derivative platforms have the biggest stablecoin LPs. So it's directly correlated to how much depth can I offer, how much volume can I offer, how many options can I offer to my user. And at the same time, I think also having it have all of these different touch points also massively diversifies its risk, because now you don't just have the single, my only counterparty isn't just perp trades, right? Because I know even if something goes wrong there's a certain amount of just USDC, USDT sitting in lending that's, has a much safer risk profile. Stablecoins are so important, man. I mean, I'd argue that's probably one of the best innovations of crypto as a whole.
Yeah. I mean, this is the last question I got for you, and it's a wild card. We've got the chat here because we are live, and so people they're loving your appearance, and so we've got this question here in the chat that I'm going to ask you. And you're right. I mean, stablecoins are extremely important. We've seen that, as a result of their growth. Now with, Robinhood chain and these sorts of things, people are saying, oh, tokenized equities are an even bigger opportunity than stablecoins. So we'll see how that plays out. Similar question here. And this is a wild card question. But I want to, give you a chance to sort of address this. Travel Wings in the chat here says, will institutional capital institutions seriously look at flying tulip? I think retail is done with Andre. Look, I want to give you a chance to just address, the perception that people may have of sort of like your journey, because look, I understand the depth and breadth that you've had in this space, and obviously, this is a feat of incredible development work that you've done building this system and walking through it. I really, really do appreciate you walking through it here today. And just to address, what some people might be thinking out there. So given this sentiment, like how do you respond to, this kind of this question, right? Around retail sentiment and institutional sentiment when, they're looking at something like flying tulip.
The only thing that matters is, does it offer better risk-adjusted yield? Does it offer more features than I get somewhere else? Or is it cheaper? Capital doesn't care.
Mm-hmm. Yeah.
So I don't think there's much to address there. I'd say the only thing I would address there is that the little circle jerk of CT narrative is very, very different than what's actually happening out there in the real world. Interest is big. There's lots of conversations, but what it comes down to is it cheaper? Is it safer? Does it reward better? And that's all that matters.
Travel Wings, I hope you got the answer to your question there. Capital doesn't care. Andre, man, really, really appreciate you taking the time today. I know we went a little bit over time. I really do appreciate, just kind of very methodically walking through some of the questions here and explaining the way that you've built this system, the lessons that you've learned from previous projects and how you've implemented this, and very excited for the growth story of Flying Tulip, to see how this plays out over time. And man, I'd love to have you back on in a couple of months again and get another temperature check on how things are going.
Yeah, always happy to. And thanks for having me. Always like talking about this stuff.
Absolutely. Appreciate learning about it. We'll see you again soon. Thanks, Andre.
Thanks, boss.
All right. That has been Andre Cronje, the man, the myth, the legend, DeFi OG, and he is not stopping building. I think that is one thing for sure. Flyingtulip.com. You guys can go there. It's live now. He talked about some of the features that are going to continue to be built. Perpetuals is going to be activated soon, is one thing that he mentioned. Also, I have double-digit rates that are currently in production. So stablecoin is the lifeblood of the system, and all of the value accrual. I mean, you heard liquidation fees, settlement fees. You heard the liquidity provider fees. All of these things, built from the ground up, both on the permission side, in the the equity lending side, as well as the permission list built up from the AMM. Look, I mean, there's tons of potential here. Andre has done this before. He knows what it takes, and so I wouldn't be surprised if he does it again. Flyingtulip.com. You guys can go over there, get playing around with the system, learn how it works, reference this video to really, really understand it, and keep tabs, because there are opportunities out there in the DeFi space that will continue to be available. Guys, I think that is going to wrap up our show for today. Yeah, new type in the chat said, what a Chad answer. Love Andre. Freedom guy in the chat. People trying to hide the truth and reality. Freedom guy's always going on about freedom and freedom of speech. Love it. Travel Wings, hope that answers your question. Beef.hl hypermeat. What a username. My question is, how long will he stick with this project before moving on to something else? His history is pretty colorful. I mean, look, guys, these things are permissionless. These things are immutable. These things are continuing to live. I mean, we've seen, I can speak from first principles here. My we've done some angel investing in the space, and I think we did something like 50 or 60 projects. Got a handful of zeros out there, never to be heard from again. So these guys, they just dip, right? Something that I can say for Andre is that not only did he actually deliver real tech, but the tech is still real. It's still in development. I was just looking at YFI when he was on the show here, and let's see, it was still like top 300. I mean, it carried something like $100 million market cap. So these things still exist, right? It's not like these things are zeros. What else we got? I think that's going to wrap us up here. Guys, appreciate you rocking with us. We're going to get Andre back in a couple months. He's going to answer some more. I think Flying Tulip is upwards of 5 million, continuing to expand, add more features as it goes. Wouldn't be surprised if that thing gets some serious TVL. Oh my God, new type. Anisha. Oh my God. Oh boy. Don't get me started. Oh man. Yeah. We the Good Idea Ventures portfolio is it's in quite a spot, but we did do Plasma, we did do EtherFi. EtherFi is carrying the portfolio right now in terms of the angels, and then obviously the liquid portfolio is cooking. What is the liquid market doing right now? Let's take a look. Yeah, Urine Finance. Got to get that off the screen there. I like Zcash to flip Urine Finance. Zcash at 550, man. I don't own enough Zcash. Bitcoin with a nice little bounce. ETH looking like it's turning around. Guys, I think we're going to rally into the weekend. I mean, market was a bit bearish on Trump's press conference last night. Still mad at myself for buying Anisha. New type. You and me both, buddy. Oh, boy. Yeah, Digi, appreciate you sticking around, man. Thanks for hosting. Much love. Guys, we're going to close out. I think the market's going to turn around for us. This has been the last show of the week. This has been Friday. Hope you guys have a happy Friday. We're going into the weekend. Pray for weekend pumps. The equities market seems like it's holding up. I think we're going to be okay. I think memory is going to come back. I don't see cracks in the equities market or the NASDAQ like people are calling for. I'm not a doomer. I think we're going to be okay. Just stay diligent, stay strong, and survive these market conditions. We are in the transition into the pre-bull, okay? So it goes bear, pre-bull, then bull. We are transitioning out of bear into pre-bull. Just stay with us, build positions, stay in spot, build positions in spot. This market is going to rally. It's just a matter of time, guys. Stay strong. Appreciate you coming and rocking with us. New type, yeah, we did indeed drink their juice hard. We were sipping the Kool-Aid. Freedom guy, you're the man. Don't get banned again. We want you sticking around, man. We're freedom of speech. We're big libertarians out here as well. Weekend rally would be incredible. Give us a pre-bull. Give us a sign of life, guys. Have a great weekend. We will see you next time, Monday, early. Much love. It's been the Rollup. Peace.